Hello there and welcome. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you for joining me tonight on the latest episode of the Discover Trading series. And tonight is called Discover Stock Trading. Reading by yourself. Of course, this is James Alexander. I'm the Chief Market Analyst here at Wise Bank. So let's do a little bit about who I am. Like I say, my name is James Alexander. I'm the Chief Market Analyst here at Wise Bank. I have over 20 years experience in the financial service industry. I actually started out at the young age of 18. Where I actually specialized in commercial mortgages before moving into pensions and alternative corporate investments. I entered the trading arena around about 12 to 13 years ago, and I've indeed traded myself through Dubai Gold and Commodity Exchange and ran several trading floors around the world. I'm indeed a published writer and have my articles published in several leading industry publications, including the likes of the Financial Times Advisor, the Wall Street Journal spin-off, which is Market Watch, The Street, FX Trader magazine, and several London newspapers. And as you can probably tell, obviously, I am from that neck of the woods. I'm indeed British, but please don't hold that against me. I am an avid market commentator. I'm very passionate about the markets, which I hope will come across with my enthusiasm as I'm talking tonight. And as well as that, I'm a well-known public speaker, and I've spoken at many industry events around the world, including the likes of countries like Singapore, Dubai, Kuwait, Qatar, South Africa, Germany, and of course, the United Kingdom. Now, tonight's agenda, we will cover the following subject. Of course, we're talking about stocks tonight. So tonight, we will talk about what actually stock CFD trading is. We'll also discuss the advantages, easy for me to say, advantages and disadvantages of stock trading. We'll talk about stock CFDs versus Forex CFDs. We'll talk about how to evaluate stocks, so how to make your decisions in what stocks to trade. And of course, we'll have my usual contact details at the end. So if you have any questions or any suggestions about future episodes, you can contact me directly. So what actually is stock CFD trading? Now, as we all know, CFD stands for contract for difference. CFD trading allows us to open a position on the price of an asset without having to actually purchase the underlying asset. Stock CFDs allows you to trade a stock of a company without having to purchase an actual share in that company. With stock CFDs, you're not actually buying something to hold on to it and wait for it to go up in value. You're actually speculating on the price of an asset moving in one direction or the other. And this, gives you a lot more options, because with stock CFD trading, it allows you to potentially profit from a bearish market as well as a bullish market. In other words, shall I say, if the CFD stock price is falling and you short it, you can actually benefit from it falling in price and actually potentially make profit. Whereas if you obviously bought a physical share, if it will go down in value, you're losing money. So this is one of the advantages of stock CFD trading. Now, let's have a look at the advantages and disadvantages of actually purchasing a physical stock or physical share and trading stock or stocks CFDs. So, first of all, let's do a little story. I like stories, don't you? Say, for example, Amazon is trading at 1,911.68 per share. To purchase 10 shares of Amazon, you would have to invest $19,116.80. With CFD trading, because you're not physically buying the underlying share, in fact, you're speculating, you could buy 10 shares of Amazon at $1,911.68 using leverage at 1 to 5. You would only have to invest $3,838.94. Now, let's carry on with the story. Amazon stocks rise dramatically to $1,995 per share, meaning that your physical investment, if you bought the physical stock, is now worth $19,950, which is a profit of $833.20. If you were trading it as a CFD, however, because it's leveraged, Amazon price goes to $1,995. Using leverage of 1 to 5 means your potential profit would actually be about $8,332. Quite a big difference. But there's a flip side to this story. Say, for example, Amazon dropped to $1,828.96 a share. Your physical investment, having bought physical shares, will now be worth $18,282.96. That's down $833.20 only. But you still have your physical investment. You still have your $18,000 also. With CFD, because it's leveraged, your position would have closed, which meant you would have lost your entire investment of $3,838.94, the amount of money you had at risk initially with the trade. Also, don't forget, when you're buying physical stock, you're likely to pay commission to purchase the shares. And with physical purchases of shares, you can only, like I say beforehand, potentially benefit if the value goes up. As a CFD, you would pay a spread, which straight away, when you open a position, would potentially mean you're in a negative. But with CFD trading, like I said, you can potentially benefit if the price falls and you can open a short position. So, say, for example, this story here, say you dropped $1,828, it would have been a loss of 18,000. So you would lose 833, meaning your capital is 18,282. If you do that as a CFD, you would potentially make $3,838, not lose it had you shorten it. Again, this is one of the advantages of CFD trading, is that it gives you more options to potentially benefit from market activity. So let's now compare stock CFD trading to Forex CFD trading. Now, stocks are only available to be traded during the hours of that stock exchange is trading on. Makes sense. I mean, for example, Amazon, Netflix, things like this, Facebook, they're American companies, so obviously they're only tradable during the time New York Stock Exchange is open. CFD trading with Forex is 24 hours a day, Monday to Friday. So you're always going to be in a position to trade the euro dollar or the British pound dollar, etc., whenever you wish. Leverage with stocks, CFDs, is 1 to 5. With Forex, it's 1 to 30. With stocks, actually leverage with Forex can actually be even higher than 1 to 30. It can actually go as high as 1 to 400, depending, of course, on your account type and obviously your attitude to risk. With stocks, there's less factors to consider when you're trading them. For example, a company's debt level, earnings, new products, market sentiment. There's a fewer things to really pay attention to when you're looking at an individual stock. With Forex, there's a lot more factors you need to take into account. This includes, for example, performance of a country's economy, economic indicators like employment, GDP, inflation, geopolitical events, global economy, technical indicators, media stories, and market sentiment. Now, when it comes to choosing a stock or trading stocks, like with all types of trading, to be totally fair, you have to do your homework. It goes without saying that you need to know and do your research before you actually go into the market. Now, there are a number of different areas you should look into and consider when deciding on what stock to trade. And these include the following. What does the company do? This is indeed, realistically, a real basic question. What does the company do? What is its purpose? How does it operate? How does it make its money? What does it do? Does it make phones? Does it make concrete? Does it speculate on analytics for different technology? What does the company do? You need to understand as well and need to ascertain if there is a market for this company's goods or services. Is demand for the company's products on the rise? Is there demand for the services? You also need to understand if there are new products or services on its way from that company which could impact its share price. Excuse me again. For example, Apple. Everybody likes Apple. Myself, not a big fan. I'm a Samsung man. I love my Samsung Galaxy Note 9, to be honest. Is it 9? It's 8, sorry. 8. I'm a Samsung man. But other people love Apple. So when you're looking at Apple shares, is the latest Apple phone, Apple 11 Mark II-9/B, how popular is that going to be? Is the market or is the buyers going to go mad about it? Are they going to buy it up? All these things can affect the company's share price. It's like Tesla, for example, their new Mark III Tesla car. How is that affecting their stock price? Is demand rising, going up? So new products is something you need to really sort of be aware of and bear in mind before you invest in that share. Who manages the company? Who runs the company? Because at the end of the day, any company is only as good as the people behind the scenes operating that business. That's the case of it. If you've got a very poor CEO or a bad track record on what they can say and how they can do things, can all affect the company price. So you need to know who's running the company. You need to understand the management team behind the company, what their skills are, and you can have to look to see, if you know their skill set, if you know how good they are, then you can see if that company has a future. As well as that, new arrivals and indeed departures can have an impact on the value of that company. Let's see a prime example, for example, if we go back to this slide here, hang on. Prime example of this is what happened with Facebook shares just recently. When one of the co-founders of Instagram left, it greatly affected the Facebook share price. It actually went downwards because of it. So these sort of things can indeed greatly affect the price of that share and that stock. Now, this is for US stocks only. Swig of coffee, sorry. And these are reports you can read. They're called the 10K and the 10Q reports. Excuse me, I've got a bit of a chesty cough today, so do forgive me. Now, the 10K report is an annual report. And the 10Q report is a quarterly report. Well, surprise, surprise. It begins with a Q. Quarterly. There we go. Here's the hint. Both is submitted to the Securities Exchange Commission, and both reports are in-depth look at the health and growth or lack of growth of a company. You can find these reports on the Securities and Exchange Commission's official website, which is www.sec.gov. And it's a good idea to have a look, see how healthy a company is before you possibly choose to invest in it. And like I say, these are free, available in the public domain. Anybody can read them. So you have an idea. It's always a good idea to have a look at these reports, to have an in-depth look at how well that company is performing or how unwell that company is performing. Who are the company's competitors? Now, rival companies are forever trying to take business from each other. So ideally, you should be aware of a company's market share and how dominant they are in the market. For example, how dominant is Coca-Cola against Pepsi? How dominant is Samsung against Apple? At the same time, you should be aware of the industry the company operates in. Is the industry growing or slowing down? For example, is demand for smartphones on the rise? Is there demand for them? Is there a demand for computer games consoles, for example, if you're looking to trade Microsoft or Sony or even Nintendo for that matter? Is there a demand for for airplanes, for airplane plants like Boeing, etc.? So you should really have an understanding of the market that company operates in. Most importantly, of course, and this is really basic, does that company make a profit? Does it make a profit? That's the whole story. Again, like I say, it's a very simple question. The fact that the company is performing is a major driver factor, the company's share price. If it's performing well, profits are growing well, then obviously share prices are likely to move higher. To gauge this, you need to follow or be aware of the company earnings report, which again is both released quarterly and annually. You can research these earnings and be aware of them whenever the earnings reports are about to be released by going on to such websites like www.seekingalpha.com. What is market sentiment? This is the other thing you need to bear in mind and take into account. And this is very, it's like trading 101. Because if you engage if the market is bullish or bearish, this is a key factor to consider. Because if the market is bullish, then investors may be more into investing into riskier assets like stocks. So stock prices could indeed rise. If the market is scared or bearish, investors may not invest in stocks, in fact, move their money out of it and into safe havens like gold. And these can really affect the price of that share or that stock you want to trade. Now, future educational events coming up. The November schedule will be released very, very, very soon. We're covering a number of topics. The next episode of the Discover series for all of November, and indeed December is coming up. So please keep a key eye out for that. If you have any questions or any ideas for future episodes, please feel free to contact me by my email, which is james.t@wisebank.com, or you can indeed follow my brand new Twitter account, which is James, or handle is @JamesAlexanderT. It's a brand new account. I've only started it a few days ago. And on that Twitter account, you can indeed direct message me or indeed follow me with my number of market updates I do every day. And I do also include on my updates possible channels and levels of interest. On that note, can I thank you very much, every single one of you, for joining me tonight. I hope you found it useful and insightful. And I look forward to seeing you next week on a new episode of Discover Trading with Wise Bank, hosted and written by yours truly, which is James Alexander. Till next time, can I wish you either a good morning, good afternoon, or even a good evening, depending on where you are around the world. Till next time, every single one of you, trade safe.